Okay, there are two cost accounting techniques, the two school of thoughts while value that is used to value inventories help you to prepare profit statement. At times helps you to take the decisions. Okay, so the two cost accounting techniques, which are different in a way they value inventory, that they prepare profit statement, and one is used for the decision making. So two cost accounting techniques are known as, one is absorption costing and the other one is marginal costing. Both are two different school of thoughts when it comes to doing all these things. Okay. How they're different and how it would lead, both the cost accounting techniques would end up having different inventory values, and due to the change in the inventory values, the cost of sales would be different. So definitely the profits would be different while you're reporting profit under absorption costing or while you're doing it under marginal costing. So absorption costing, as we already understood, that absorption costing values inventory on the basis of the total production cost. On the basis of the total production cost, in which is basically sum of prime cost plus variable production overhead plus fixed production overhead, which is prime cost plus variable production overhead plus fixed production. Okay, and marginal costing, as the term marginal cost is a cost that is incurred on one unit of a product or a service. Okay, so if I'm going to produce one more chair or one more laptop, okay, so definitely my marginal cost would increase only. Marginal cost is a variable cost that is incurred on one unit of a product or a service. So if that's why it is marginal costing is used, which is also a form known as variable costing method. Variable costing. This is a kind of full absorption, full costing method. And this is a variable costing method. It values inventory on the basis of the variable cost. Marginal costing values inventory on the basis of the variable cost. Okay, if you're talking about the inventory valuation, how it values inventory, right? Talking about inventory valuation, starting from material up till finished good. It just values inventory on the basis of all of the cost that is incurred in the production function, whether direct, indirect, whether variable or whether fixed, right? But marginal costing values inventory on the basis of the marginal cost. And marginal cost is variable cost. Inventory valuation. So it values inventory, okay, on the basis of the variable production cost, on the basis of the variable production cost. So what is the variable production cost? Just take the variable portion. Just take the variable portion of prime cost is a variable cost because it is incurred on every unit of product or service. If you're making a new chair, definitely the prime cost is going to increase, and also the variable production overhead would increase. Okay, but no, the rent won't increase, right? The rent won't increase. So it values inventory on the basis of the marginal cost. That is basically, which is a cost which is incurred on one unit of a product or a service. It doesn't value inventory on the basis of fixed production cost. It considers fixed production cost as a period cost. It says it is not incurred because of producing one extra unit. It is a cost, which is a period cost. Then we are going to look at what is product and what is a period cost under both methods. So it values inventory on the basis of the marginal or variable production cost, and which is prime cost plus variable production overhead only. So what do you think the difference would be? What creates the difference is basically the treatment of fixed overhead. One absorb fixed overhead into a unit, let's say a chair. For example, prime cost is 10, variable overhead is 12, and fixed overhead is 2, 10, 12, 10, 11, 12, 13, 14. So absorption costing would value a chair on the basis of one chair on the basis of 10, 11, 12, 13, 14 full production cost, since it's a full costing method. It would value on 14, but this would only value a chair, one chair on 12, because that's what it's considered to be a marginal cost, which is a variable cost, which is incurred in producing one chair. So it would value inventory on the basis of 14, and it would value inventory on the basis of 12. So it kind of undervalues inventory. So marginal costing is not in conformity with IS2, which is basically inventory valuation standard. That standard follows the full absorption costing method, which is basically that fixed overhead charge absorb rent predetermined over as a result of with the help of predetermined standard rate absorbed overhead into one share. And then when you're gonna see what the actual overhead are, okay, at the end of the period, you can just adjust the under over absorbed overhead in the profit to get the correct profit. Okay, so that's the rationale of absorption cost. But it does absorb, charge that fixed overhead into a unit. It does make it a product cost. So what do you think? What do you think product cost is? Product cost that is related to a chair. What do you think it is? It is yet again a total production cost. In absorption costing, a product cost on which we value inventory, it is basically because this school of thought thinks that the rent and the depreciation and the machinery that is incurred because of producing a unit, because of producing. So it should be absorbed into one unit. So that's how you get a full cost. So, so it undervalues inventory because it only values inventory on the basis of the marginal production cost or marginal or the variable portion of the production cost. It doesn't charge inventory on the basis of the fixed production cost. It's considered fixed production cost to be a period cost, not to be a product cost. So what do you think is the product cost here? Yet again, the product cost here would be total production cost, which is prime cost plus variable production overhead plus fixed production. And what do you think here would be the fixed cost, the period cost in absorption costing? The period cost in the absorption costing is, since total production cost in absorption costing is a product cost, so the period cost would be definitely your non-production cost. Your non-production cost is basically your period cost. And here, what is your product cost? Product cost is what is the value of a chair. Here, a value of a chair is 12, and which is basically the marginal production cost. That's the marginal production cost is a product cost. Here, the value of chair was 14, which was total production cost. So the product cost is marginal production cost is a product cost, or a variable production cost is a product cost. And what is a period cost? What is not absorbed? It says that fixed overhead is it relates to a time period. It doesn't relate to a product. Because if I produce one more chair, one more laptop, one more car, definitely rental cost won't increase, or the fixed expenses or fixed cost won't increase. So it has got nothing to do with the product, but it has got more to do with the period, right? So it says fixed overhead is a period cost along with the non-production cost, along with non-production cost. So what do you think? Here non-production cost is also period cost. Here non-production cost is also period cost in conformity. Here variable production cost is also a product cost. Here variable production cost is also a product cost. So what's the culprit that actually gonna make the inventory value different and the profit ultimately, because that's going to impact the cost of sales and profit different? Well, what's the culprit? I actually wrote it down there. That's the culprit. What creates the difference is the treatment of fixed overhead. One is absorbed into product and one is not absorbed into product, and it's just charged to period. Whatever is the actual fixed overhead incurred in that particular period for which you're making the profit statement, you're going to release that entire fixed overhead cost in case of marginal costing to that period. What is a product cost? We need to know what is a product cost and what is a period cost, and how is it going to create the difference in profits, the treatments because of fixed overhead, create difference in profits. You need to understand what is a product cost and what is a period cost. Product cost. Why a product cost is a product cost? Because when that product is going to be sold, like a chair is going to be sold, okay? So product cost is only charged for the period you're making a profit statement for. Product cost or total production cost is only charged in the period for is only charged for the goods sold. For the goods sold. It is only charged for the goods sold. Okay. So if you are producing more chairs but selling less chairs, so in absorption costing, less fixed overhead would be charged in that period. Because, for example, you produce 10,000 chairs, okay, but you only sold 5,000 chairs and your 5,000 chairs are still in your closing inventory. So what do you think? Product cost is only charged up to the extent for the up to the unit sold. It's only charged for the goods sold, and for the goods unsold it is not charged in that period. But here, when fixed overhead wasn't absorbed into the product, but it was the entire was released into the period. So whether the goods are in the inventory or not, still the entire fixed overhead, which pertains to a certain period for which you're making your profit statement, would be released in entirety in that particular period. Because period cost, definition of a period cost is a cost which is expensed out in total in that particular period. In that particular period. So here, when product cost is only marginal production cost, here it is also marginal production cost is actually released in the period. But here the difference is because of the fixed overhead. If we produce more, but if we sell less units, more are in the inventory. So the product cost would only be charged in the period for the goods sold. Okay. So for every unit sitting in the stores which are not sold, 2 per unit cost won't be released in this period. 2 per unit cost won't be released in the period. And when I say the 5,000 units are still in your inventory, considering opening inventory was 0, you produced 10,000 units, but you only sold 5,000 of those chairs, and there's still 5,000 chairs are sitting in your inventory. So for every item sitting in your inventory in your warehouse, not yet sold, carries a charge of 2 as a result of absorption, right? Because absorption charges fixed overhead to units, right? So it is actually carrying that charge, holding it up for you. And until these units are not sold as well, that charge won't be released in that period. So what do you think? What do you think? If closing inventory is more than the opening inventory, or if you produce more than you sell, that means your closing inventory is more than the opening inventory. Which method has reports a higher profit, whether it's absorption or whether it's marginal? Whatever may be the actual fixed overhead, the entire would be released in the period. In case of marginal costing, the entire cost would be released in the period, right? But here, fixed overhead for the good sold is only released, for the good unsold it is not released. So 2 per unit into 5,000, 10,000 would be locked up in that inventory, not sold. So for example, actual fixed overhead was 60,000 and marginal costing charged entire 60,000. However, absorption costing would only charge 50,000 and it won't charge 10,000. That's the profit difference. That's the profit difference. Why? It will not charge 10,000 because for 5,000 chairs sitting in the inventory, each carrying a fixed overhead charge of 2 is basically product cost there's a matching concept applies, which is same as the rule of a product cost. Revenue is for 5,000 units only, so we have to match our income to our cost. Only 5,000 units, the cost would be entire product cost would be charged, and for the 5,000 units sitting in the inventory, that 10,000 cost won't be charged. So what do you think would be the profit difference in marginal costing MC? 60,000 of fixed overhead was charged. In absorption costing, 50,000 was charged. In absorption costing, 50,000 was charged and 10,000 was not charged. So profit difference would be that 10,000. And who reports a higher profit? Who reports a higher profit in this scenario? When production is more than units sold, production was 10,000, units sold was 5,000. That means closing inventory was greater than opening inventory. Absorption profit is higher than marginal profit. Why? Because absorption, less cost is charged. Less cost is charged. And in marginal, the entire period cost is released in that period. Entire cost is released in that period. Entire. So what's the culprit? What creates the difference in the profit while reporting under both methods, whether you're using absorption or marginal? Which is basically the treatment of the fixed overhead, which is the product cost here. So it would be charged up to the goods sold and not charged for the units unsold. So if you have more unit unsold in the period, less cost, less fixed overhead would be charged and more the profit would be. But if fixed overheads are not absorbed into product, but it is a period cost, considered to be a period cost, which is in case of a marginal costing, the entire would be charged, like 60,000 would be charged here and 50,000 would be charged here. 60 less 10,000, 50,000 would be charged here. So that's the difference in the profit. How you reconcile the profit difference. How you reconcile the profit difference. I'm just going to write the formula. Profit difference. How you reconcile. Profit difference. The formula for profit difference. Units in opening inventory minus units in closing inventory into standard fixed overhead absorption rate per unit. As per my previous example, fixed overhead absorption rate was 2. There was no unit in the opening inventory and the unit in the closing inventory was 5,000 into 2. What was the profit difference? Was 10,000. Absorption profit would be 10,000 higher and marginal profit would be 10,000 lower. Since 60,000 was charged here, but here 10,000 less cost was charged, only 50,000 was charged. And that was the difference in the profit. Culprit is this and the change in inventory. What is the formula? Change in inventory. If the inventory level is increasing, then absorption profit is higher. Okay, but if opposite goes, that inventory level decreases, opening is more and closing is less, then the case would be the opposite way. So there are 3 cases when you are understanding the profit, doing the profit reconciliation between absorption profit and marginal profit. Remember this formula first and remember these 3 cases. Case 1, case 2 and case 3. In case there is a change in inventory, then only there will be profit difference. If there is no change in inventory, opening inventory is equal to closing inventory, then the difference in profit would be 0 as per this formula. Case 1, if I produce more, sell less, which was in this case, my closing inventory would be greater than the opening inventory and my profit under absorption would be higher than the profit under marginal, which is the case here. Okay, where I produced, opening inventory was 0. I produced 10,000 chairs, but I only sold 5,000 of it, and still 5,000 is still sitting in my inventory. That's how the profit difference was 10,000. So absorption profit was 10,000 higher and marginal profit was 10,000 lower. Okay, which absorption profit reports a higher profit in this case. And this is a case of increase in inventory. Increase in inventory from 0 it rose to 5,000. That's the increase in inventory. In case of decrease in inventory, and in case of no change in inventory, that's the third case. No change in inventory. Okay. Okay. Case 2. If production is less and you sell more, how come is it possible? It will be possible because there will be some opening inventory there. In this case, opening inventory would be more than the closing inventory. That's what the decrease in inventory would be. Because more are sold, right? The opposite of what happened here would be the case here. Here, marginal profit would be greater than absorption profit. Why? Consider a scenario. For example, opening inventory was 2,000. I produced 10,000 units, okay, but I sold 11,000. And what is my closing inventory then? 12 minus 11, 10 to 12 minus 11, 1,000. So there's a decrease in the inventory level. There's a decrease. Here it was from 0 to 5,000. It was increase in inventory. So the change in inventory creates the difference. Increase, absorption reports a higher profit because the items sitting in inventory, fixed overhead won't be released in this period, right? Now, consider here. This closing inventory would become opening inventory in the next period, right? So if it wasn't charged in this period, it would be charged in the next period when it would be sold. No? It would be charged in the next period when it would be sold. Right? So, in the next period, if here absorption report a higher profit, in the next period it's going to report a less profit. Why? Why? Because some earlier overheads would also be released in the period. Some carried forward overheads from last period would also be released in this period. Would also be charged in this period. Would also be released in this period in case of absorption costing. So in the next period, absorption costing, more fixed overhead would be charged. More fixed production overhead would be charged as compared to marginal costing. Because in marginal costing, only the fixed overhead for the period, irrespective of units sold or unsold, it is a period cost, the entire would be charged. But here, some carry forward overhead from the last period, like from 2,000 units, and then 11,000 are also charged, 2,000 for the goods sold, and the less, since it's a decrease in inventory, and less overheads would be transferred to the next period. So in this scenario, where there's a decrease in inventory, more fixed overhead, earlier less fixed overhead was charged. Earlier less fixed overhead was charged in absorption, that's why the profit was higher. But here, since more overheads would be charged, more overhead would be charged as compared to marginal costing. So hence, because of the opening units also getting released in this period, more overhead would be charged in case of decrease in inventory. So here, absorption reports a less profit. And how would you calculate the difference? Yeah, the same way. The same way, opening inventory 2,000, closing inventory 1,000 into, for example, fixed overhead absorption rate is 2. So here 1000 into 2, the difference in the profit under absorption and marginal would be 2000 profit difference. That's the formula of the profit difference. Yeah, same units in opening minus units in closing into standard fixed overhead rate per unit. And here absorption profit would be 2000 lower and marginal profit would be 2000 higher. Consider the third scenario in which you produce equal to the units sold. You produce equal to your units sold. For example, you're producing 10,000 units and you're also selling 10,000 units. For example, here your opening inventory would be equal to closing inventory. No change in inventory. No change in inventory. No profit difference. Here absorption profit and marginal profit would be the same. Here profit into marginal and absorption would be the same. Okay. For example, opening you had 2000 units. You produced 10,000 units, but you also sold the entire 10,000 units. So what do you think would be in your closing inventory? The same 2,000 units you had when you opened the period. That's the same quantity. So no change in the no change in inventory. So no change in the profit. So first we identify the difference for the profit under marginal and absorption is this fixed overhead, which is product cost in absorption, but which is a period cost in marginal. So the entire, irrespective of goods sold, entire is released, but in case it is a product cost, in case of absorption, it is only released up to the units sold, and for unsold units the cost is not released. So here when the inventory is more, closing units are more, so less profit would be released and more the profit, the less cost would be released, the more the profit would be. But the same cost would be released in the next period when it will come in the opening inventory. So carry forward overhead would come. So in the next period, more fixed overhead would be charged in absorption costing. So that would make the profit of absorption lower than the marginal, because marginal would only have the cost, whatever is the cost in that period would be charged in that period in entirety. No cost coming from the previous period. But here in absorption, when that closing would become opening, some carry forward overhead would also be released in the next period. So the next period definitely absorption would report a lower profit. And then it goes like this. So overall, there's no change in profit. Overall, profit varies. Overall, no change in profit. Overall, no change in profit, but profit from period to period only varies. Profit from period to period varies. Period to period varies only. Okay? So always remember this. In the next lecture, we're gonna actually solve question and then actually will reconcile the profit. This question we're going to do. So here, whenever you're producing more but selling less, so for example, opening is 0 in this case, and if you produce 2500 units but you sold only 2300 units, so the closing inventory would have 200 units, and in this case, yeah, that's the case number 1. Absorption profit would be higher than the marginal profit. And what would be the profit difference? For profit difference, I need units in opening, units in closing, and third thing I need is standard fixed overhead absorption rate, standard fixed overhead absorption overhead, which is 30 per unit. So what would be the profit difference here? Now I can tell you absorption profit will be higher, but by what amount? So it would be units in opening minus units in closing inventory into standard fixed overhead absorption rate per unit. So it is going to be 0 minus 200 into 30. So the difference between profit would be 6000. Here absorption profit would be 6,000 higher and marginal profit would be 6,000 lower. Okay.